I hope your head is not spinning from all this mortgage talk. Oh well, that's just me being silly. So before we turn to purchasing real estate as an investment, let's discuss some of the technical details that one must become familiar with if you're going to be involved with real estate for any reason. First of all, there is the plethora of transaction costs, expenses. Assuming brokers are used, and there could be two, one for the buyer and one for the seller, typically the seller pays broker's fees, although in some cases it can be split. Broker's fees usually run from 3 to 6%, where the lower rates are usually for the multi-million-dollar transactions. Then there is financing, and there are many ways for a buyer to finance the purchase. But first, a lending institution has to deem you creditworthy enough to make your mortgage payments. A mortgage is a loan, so the lender wants to intensively study everything financial associated with you, including all your assets, any income from your job or otherwise, your family situation, and any debts that you may already have. It was not paying attention to all of these details that helped bury the housing market between 2004 and 2008, with many bad loans being extended during that time. As a result, lenders are now much stricter in deeming you a worthy investment for them in terms of lending you money. Although your home is collateral for this loan, most lenders would prefer not to acquire your property in the unfortunate case when you cannot make the mortgage payments. Lenders would prefer not to be owners of real estate, and if forced to become so, then it usually looks to liquidate as soon as possible and recoup as much of their money as fast as they can. The situation is sad for both parties, because the lender has no incentive to sell the property for as much as it is worth, as it merely wants to get its loan value back. Since the foreclosed borrower is entitled to any residual assets if the foreclosed property is sold above the value of the loan, this is another way that an in-over-the-head owner can be hurt. No one wants to be foreclosed on, so great diligence must be taken to address the affordability issues that I mentioned in the last topic. You must be realistic about your assets, current and in the future. Since you will be asked to put down a moderate down payment, you must feel very comfortable making the future mortgage payment over a long period of time. You may have several choices for your loan besides the amount borrowed. The amount borrowed could depend upon what the bank will accept as a down payment. But once they have made that decision, there is nothing stopping you from borrowing less than that amount that they agree to lend you. In addition, you'll have decisions to make about the term of the mortgage, often 30 years, but it can be less time than that. When it is less, you will have greater mortgage payments since you will have agreed to pay the loan back in shorter time. Everything else being equal, you will always look to borrow at the cheapest interest rate possible. You will usually get a lower rate for a shorter term loan, but your mortgage payments will be higher as you agree to return your principal back in a shorter time. You will also get a lower rate if you are deemed very credit worthy, because higher risk borrowers have to pay higher lending rates, as we discussed in the bond topics. In fact, the higher risk, higher mortgage rate class is often referred to as subprime lending, and so typically foreclosure rates are higher for this class. But most important in buying a home and financing with a mortgage, you must think of the interest component of the mortgage payments as an expense, because that's what it is to you. Included in all the transaction costs are all sorts of municipal fees for taxes, deeds, recordings, and any way they can get you. So all the transaction costs can add 6 to 10% to the cost of the property up front. Then there are, of course, the ongoing expenses in the future for the mortgage and for maintenance. In addition, lots of thought must be given to the condition of the house. There are necessity costs of things that have to be fixed to be livable. Clearly, if the house is new, there shouldn't be many of those. but secondary market homes, in other words, lived-in homes, there might be some of these necessity costs. The buyer should engage an inspector to make sure that any problems are identified before a purchase. Hidden problems surfacing later means more expense to the new homeowner. If you are financing the purchase with a mortgage, you will be obligated to have the home appraised of its market value so as to make sure that you are not overpaying for the house. Banks don't like to lend money to people overpaying. Remember, that home is their collateral. Next is to figure out both future taxes and insurance costs for home ownership, as that will be a recurring annual expense. Then there are the optional expenses of home improvements to suit taste of the buyer as the future resident. This includes all luxury items that the owner would like to improve the quality of life in occupying the home. So after determining one's budget for purchasing a home, including expenses, before even bidding on a home, one has to do a good job in estimating all these expenses. This analysis, combined with an accurate assessment of one's financial situation, will help to ensure that the purchase turns out to be a wise choice for the long haul, which is everybody's goal. Unfortunately, no matter how accurate the buyer is on both counts, there are no sure things in life, and unusual things can happen that can change things for the worse. Sometimes on a macro global level, but also on a personal level. It is imperative that potential buyers understand clearly the finances of home ownership, including all obligations and risks. As I said before, home ownership can be a wonderful thing if it's approached correctly, with open eyes and thoughtful analysis and hard work. Yes, it is hard work to find the most suitable home for you in terms of taste and costs, but it likely can be done. Good luck to you. Thank you very much.